Okay, so when you have a self-managed superannuation fund, and can I just ask how many people in the room already have a fund set up? Just show of hands. Yep, good. Okay, so when we have a self-managed super fund, there's a few things that we have to make sure that there's a broad framework that we have to make sure that we're complying with at all times. And I just want to run through those first of all. So the first thing is the Superannuation Industry Supervision Act. So this is the main piece of legislation that governs all super, but it particularly governs self-managed super funds as well. And it's really important that we always comply with the SIS Act. So probably one of the main sections of the Act is section 62, which says that at all times the sole purpose of your self-managed super fund must be for the provision of benefits on or after retirement. Okay, so everything you do has to come back to that sole purpose. And if you keep that in mind when you're making decisions on your fund, you can't go too far wrong. The next one then is your trust deed. So many of you might also have a family trust or a discretionary trust, and often you would have got your trust deed back in 1972, put it in a drawer and never looked at it again. That's not the case with your super fund trust deed. It's a living document that you have to abide by at all times. And if for example, something is available under legislation but is not available in your deed, then you can't do it. So you have to make sure your deed is kept up to date. And when you're undertaking transactions in the super fund, you have to make sure that they're allowed under the terms of your trust deed. Then we have the Financial Services Reform Act. So this Act came in 2001, and it really governs how people like myself, professionals, are allowed to give you advice. But in 2004, it was updated to actually capture trustees of self-managed super funds. So from time to time, you will be giving yourselves as members advice on what to do in the fund. And when you're telling yourself what to do as a member, you must give yourself a product disclosure statement or a prospectus. So it kind of sounds a bit funny. If you've got a really good deed, then you should have a product disclosure statement with your deed. But if your deed hasn't been upgraded in the last 5 years or so, or since 2004, it won't have that in it, which is important. The next thing that's really important is the compliance documents of your fund. So these are the documents that prove that what you say is happening is what is actually occurring, okay? And this is particularly important if you ever get audited by the tax office. As an example of this, how do you prove that you're taking a series of pension payments out of your fund and not just taking regular lump sum withdrawals, because there is a difference in the treatment of those things. So the only way you can prove what's happening is by having well-documented pension minutes that say this is actually what's occurring. So you need to do minutes every time you make a decision in the fund to document what you're doing. Then we have the Tax Act, and this is the other really important one to make sure that you comply with. And the Tax Act covers how we're taxed when we're putting money into super, the tax treatment inside the super fund, and then what happens tax-wise when we're taking benefits out of the fund, either on retirement or on death. So it's, again, important that we're up with that. And the last one now is the Family Law Act. Because superannuation is now a splittable asset in the event of divorce, we also have to take that one into account as well. So if you take nothing else away from tonight, I'd really like it to be this one thing, and that is that superannuation is not an investment, it is simply a tax structure. When the media carries on and says, you know, superannuation is up 10% this year or down 20% last year, they're really contributing to this ongoing fallacy that super is an investment. It's not, it's a tax structure, and it's important that you understand the difference. So when we look at what tax structures are available within Australia, we have a company which has a tax rate of 30%, so we can carry on a business in our company or we can hold assets in the company, but the tax that you're going to pay inside the company is 30%. Next we have a family trust, and family trust are a discretionary trust. The trust doesn't pay tax itself, it has to distribute its income either to a company or an individual or to another beneficiary. Then, of course, we have your individual tax rates, where you all pay tax at the marginal tax rates depending on your income, and of course that can be up to 46.5% depending on where you fall. Lastly, we have a self-managed super fund, and you'll notice I've made it the same shape and colour as the trust, and that is because a self-managed super fund is just a trust. It just happens to be a trust that comes in under the superannuation legislation. So with a self-managed super fund, the tax rate inside the super fund is 15%. And if you have a look up there and say, where would I like to hold assets long term, it would be obvious to me that we'd want to hold our assets long term inside our self-managed super fund in that 15% low tax environment. The really fantastic thing about superannuation, though, is that the minute that you start a pension from your super fund, the tax rate of the fund drops to 0%, no tax payable. So I think usually people are aware that once they reach the age of 60 and start drawing a pension or take lump sums out, that they can take the money out of super tax-free. But it's really important that you understand that the earnings rate within the tax rate within the super fund is 0 once you've got a pension started. And I'll go through some case studies later tonight to show you how that can benefit you.